Intel stock, INTC, has my interest, especially as I've noticed several prominent value investors have made Intel a core part of their investment portfolios. And it's easy to see why Intel would be treated and considered as a really attractive value stock. You have significant free cash flows, you have secular tailwinds, you have insider buying and a cheap valuation. So a lot of things add up to saying, hey, this is the typical value investing sweet spot. This could have a lot of potential. And as I look at Intel, I definitely understand it. I definitely understand why I think someone like Seth Klarman, who managed Baupost Group, is looking at this and thinks, hey, this could have a couple of 100% upside. That's actually what I'm penciling out as I look at it. I'll talk more about that in a second. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm no expert on Intel. This video is actually my first time sort of peeling it apart, trying to understand. So this video is going to walk through what's really the core drivers of their business right now, and what do I think about their valuation, and sort of how does the competitive dynamic look like. Just quick takes looking at all these different things. Let's dive right in. First, as usual, in full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Intel, INTC. So diving in, and so first of all, as I've mentioned, it definitely has this fascinating setup. You've got insider buying, around current prices, around $49 a share. The new CEO, he bought, last month, $500,000. And you can see not just him, but several others, folks on the board that are buying. And their valuation is also near its historic lows. I'm not saying it's the absolute lows, but it is, here's a chart that goes back, over a decade. You could see on a price to sales multiple, it's towards the lower end. If you look at it on an earnings basis, it trades around 10 times earnings. And while everyone knows, Intel, it's a semiconductor chip manufacturer, that's a statement that doesn't actually help me understand what's their business, what do they do. So I want to peel that apart a little bit to see, okay, what's really driving this here? So they have 5 different operating segments, of which 2 drive most of their business today. That's client computing, think personal computers, and data centers, think servers, or for enterprises. While their other segments like Internet of Things and mobility for like autonomous vehicles are growing much faster, their client and data segments are around 90% of their revenue. So the chips that they design and manufacture and sell into those end markets like client computing and data center, that's really the key part that we should focus on. So let's start with client computing. Their client computing segment comes across as low growth, low future potential, because at the end of the day, look at the market volumes for PCs. You're not talking about, hyper growth from here. Really, the conversation goes around a cycle driven off of a replacement. Like, hey, how old is the average computer out there and how soon does it need to get replaced? This is quite different from, let's say, the early 90s when Bill Gates was talking about making sure that there needed to be a computer at every desk, a computer in every home, where there's just this wide opportunity. I would say that sort of growth opportunity is much slower now, as replacement cycle is a much bigger component. So then that gets to the next component of data center group. So it is important to recognize, okay, slower growth there. It's not going to be a big driver in terms of growth when you think about this business, and growth is a key aspect of fundamentals. So then their data center business looks like a steady grower, growing in the third quarter, growing about 10% year over year. This compares once again to client computing, or this personal computer driven segment, which was down 2% year over year. So data center up 10%, and they're tapping into this huge market with over a $200 billion total addressable market. I'm thinking lots of potential here, especially as you think more and more companies are needing to build out these data centers. Data is oftentimes quoted as data is the new oil. A lot of folks are saying, hey, we need to be making these physical investments, own the servers, and looking at this, I'm thinking, yeah, this is a growth market. It's not surprising to see them grow in unit volumes and price. Looking at the demands from various different cloud, companies. The challenge is that there are actually several red flags here despite the growth, which is that you look at some of their competitors like NVIDIA, and their data center business is growing 50 54% in the most recent quarter, and they're rapidly catching up in terms of size and scale. You can see it's nearly $3 billion in the most recent quarter for NVIDIA. AMD, another semiconductor competitor, announced on their third quarter 21 results, their data center sales more than doubled. So when I'm seeing this, this channel is called Unrivaled Investing. I'm looking for companies that have an unrivaled value proposition, because when you're unrivaled, it means you have the right to win. What I'm seeing here is you're very rivaled, and that there are other players that are rapidly taking share, rapidly gobbling the market up, and you're not moving as quickly. So that is a very real red flag, and in all likelihood, that would probably be a deal buster for me as I look at this. Now, it is worth understanding that many of Intel's competitors are fabless. So, what's that? And I'm not saying fabulous, I'm saying fabless. So that means they're relying on others like Taiwan Semiconductor and Samsung for the physical manufacturing of the semiconductor. So they might design it, but they will rely on others to produce it, test it to make sure it's working. So this is in contrast to like Intel, which designs and makes many of their own chips. So they have the physical infrastructure as well as designing and selling it. So these fabless players, they've sort of split it up from let's design it and let's sell it to folks. And these other, companies like Taiwan Semiconductor, they will focus on the really difficult, challenging part of building these really complex factories, whether or not it's Taiwan Semi or Global Foundries or Samsung. Now, this is part of the reason why Intel might be perceived, and I think it would be perceived, as a strategic asset in the United States and Europe, because they're saying, hey, we're willing to make these foundry investments in the United States, in Europe, to provide that sort of stability. Because look, if a country can't get access to computer chips in the future, to semiconductor chips in the future, would be a destabilizing force. And so the risk of this being solely concentrated in Taiwan and South Korea, having the latest and greatest tech coming from there, does create geopolitical risks. And so this is why Intel, I would argue, is viewed as a strategic asset, and you are getting investments effectively from the U.S. And here it is, they're talking about breaking ground on not one, but two new leading edge chip factories in Arizona, investing tens of billions of dollars. Now, I'll do a whole separate conversation on our Discord server, for the Unrivaled Investing Journey subscribers, about the pros and cons of asset-light businesses. The reality is Buffett talks about it extensively in his letters over the last few decades, where generally the more asset-intensive business you are, it actually makes you less attractive, and it's harder to get an attractive return. And so here it is, you're looking at this and you're thinking, okay, so Intel is an asset-heavy business versus something like NVIDIA, and you can just look at the stock chart for NVIDIA and Intel, and you can see, okay, the market rewards asset-light businesses that can grow very quickly and specialize. Okay, so what are the thoughts about Intel? Now that we've seen that stock trades at a low part of its valuation, it's a strategic asset. Has very real business dynamics that will likely involve some growth. May not be hyper growth. They might be losing share. But first, a quick plug. If you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out potential multi-baggers as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So once again, if you're interested, go to unrivaledinvesting.com, click join the journey. And if you enjoy learning about potentially exceptional companies, please make a point of hitting that subscribe button. And so thinking about Intel's valuation, so here's their guidance that they provided in their third quarter results. It currently trades around 10 times earnings, around 10 times, actually technically closer, sub 10 times, because they're saying their non-GAAP earnings per share is going to be over $5 versus their $49 share price. And so you're thinking, okay, this could actually be quite cheap. The reality, though, is that it could be well-deserved, and that's the challenging part with Mr. Market here. Is sometimes cheap valuations are warranted, and sometimes expensive valuations are warranted. And so you're looking at Intel; they're clearly losing share to faster-growing semiconductor players, and they're expecting little growth this year. They're saying 1% growth year over year. You look at some of these other players that are growing 50%. So that does reflect that the marketplace is excited about the solutions that others have to offer. So from an unrivaled perspective, that's a pass for me. That said, I could understand, like, let's dive into why, and some folks don't care about the unrivaled aspect. Some folks are like, hey, I just want to make sure it's cheap. Like, Seth Klarman or like Michael Price. And so they're looking at this and saying, hey, this is what I presume they're thinking, is that, this trades under 10 times earnings. And, if it resets and you get some growth, then you can have a home run. We'll talk about that in a little greater detail in just a second. But part of the reason why I think it might trade at this discount is because they're losing share. And it's questionable whether or not they're going to be able to get a lot of growth in the future. And also their free cash flow is quite a bit lower than what their actual earnings are. So their earnings sort of overstate what their actual free cash flow is, because what you're really looking at is only around $12.5 billion in free cash flow, whereas their implied earnings is around this is around a $200 billion company. So to say 10 times earnings, that would imply around $20 billion in earnings. Whereas here, free cash flow is only 12.5, and so at least that's what they're guiding to, and that's because they're spending so much on building out physical production, trying to catch up with these global competitors like TSM, Taiwan Semiconductor, these other foundries, and they're trying to catch up with their abilities. Recently it sort of was a disappointment for Intel to say, hey, we're going to actually have to use a different foundry to produce these chips. That does reflect that they're no longer the cutting edge. Now, in terms of management's outlook, management believes they can right the ship, and they think they can grow at 10 to 12% annualized over the next 4 to 5 years. Now, that's part of the reason why they're making this big bet. They're saying, hey, yeah, we expect to spend, maybe $20 billion in 2021. We're going to be bumping that up to $25 to $28 billion in 2022. I would expect continued major investments because, you are getting support from Western governments saying, hey, we want to make sure we have a steady supply of semiconductors. So let's make sure you invest in this. But at this point, I think from the stock market perspective, it's a show me story where they say, hey, yeah, you're only growing 1% this year. If you want to get the valuation credit of a company that could potentially grow at 10 to 12% and be valued at that type of thing, we need to see it because 1% is very different from a 12% CAGR over 5 years. So as I look at their potential valuation around $200 billion market cap, looking at effectively flat growth this year, really juicy margins around 30%, assuming that it's going to be that way in the years to come. Assuming a range of future growth scenarios, from management hits it in the high scenario of 12% to, maybe they don't with 4 to 8%. And assuming a range of earnings multiples where in the downside case, they don't get really credit for any sort of multiple expansion to 15 times, where effectively you get a 50% increase in the valuation from the 10 times today. And, based on that and the fact that management has a history of returning significant amounts of capital to shareholders, whether or not it's buybacks or dividends, then what you're looking at is potentially a very attractive return, potentially over 200% upside. I'm penciling out maybe 28% annualized on the high side. I mean, that would be amazing. And once again, that's driven off of the two twins of potential return here, which is, hey, if you get significant fundamental growth, then you could also get potential multiple expansion, which so you're getting fundamentals and valuation expansion. Those are two rocket engines that can drive a lot of growth in terms of the stock price. And so that it really depends on management executing. If they can execute and deliver on that 12% annualized target from here, and its stocks resets to 15 times earnings, you definitely could look at something that's 200% upside. Now, keep in mind, this is a hypothetical valuation framework. Stock prices can definitely go higher or lower. I'd say a lot depends on its execution. A lot depends on competitive dynamics. What does this business ultimately look like in 5 years from now? Personally, just given my own personal journey, this is too hard for me. I try to find things that I think are unrivaled. I don't like seeing others take share from them and grow much, much faster than them. 50% growth versus, 10% growth, that is a red flag. Now, unless something happens to TSM from a geopolitical perspective, which is possible, it's not obvious growth from here in terms of saying, hey, Intel, if something happened to, let's say, some of their competitors, that produce some of the physical production of semiconductors, where the U.S. said, hey, we can only order them from the United States, then I'd say, oh, okay, now you're in a much better position, and now maybe you can, your margins could go up or something like that. But we're not quite there. It is a strategic asset, no question, as I'm thinking about this. But I'm just not looking at this thinking, yeah, this is going to be, unrivaled and just have incredible growth for sure. I'd say let's see what their execution looks like from here. I called out to my Unrivaled Investing Journey subscribers a company much smaller than Intel, growing over 100%, trades at a much higher valuation, but I think it is something that is unrivaled. So that's the reason why I'm willing to own it. I think it has something like 500% upside. But, for folks that like the value, the strict value plays like this, I could definitely, I definitely understand it. And so if this video talking about Intel, sort of the risks, the rewards, potential upside, potential downside, think about, like, hey, there is a lot of favorable data points here. Low valuation, lots of free cash flow, strategic asset, insider buying, value investors love it. So you could see this and you go, okay, I get it. This is the odds of this bet are generally a little bit better than let's say just picking a random SPAC, for example. But yeah, I think everyone has to have their own journey. If this is part of your investment journey, if Intel's part of your investment journey, I'd absolutely love to hear it. So leave a comment below on your thoughts. If you think I'm missing something or there's a bigger angle or element to consider, definitely leave a comment. And if you enjoyed this video, please make a point of subscribing and hitting that thumbs up. Thanks so much for watching.